Hi folks, welcome to this video where we're going to take some data from the question and try to determine what the cash balance should be on the statement of financial position. So for this particular company, fashion company, they're trying to determine how much cash they should report on their statement of financial position. So we need you to calculate that given the information below. And anything that you've decided in this information below that doesn't belong in that account, where would you recommend we put it? So let's have a look at this first item. Now, the first item says that fashion company has a commercial savings account, $600,000, and also a commercial checking account balance of $900,000. Both of them are being held at the First National Bank. There's also a bank overdraft of $35,000, and it's being held at the Royal Scotia Bank. Since the company doesn't hold any more accounts at the Royal Scotia Bank, one of the things you're going to have to determine is how do we deal with the bank overdraft. Now, you know from previous classes that when we had an overdraft, if we did not have the overdraft account at the same bank as we had our regular cash account, then at two different locations, we need to make sure that we set up the bank overdraft as a current liability. So this is an amount that will go as a current liability. But these two amounts, the $600,000 and the $900,000, they're fine to be included in the cash balance. So what we would say is if we're trying to determine what our cash balance should be, we're going to put in the commercial savings account balance of $600,000 and the checking account balance of $900,000 in that cash account. Notice down here, because $35,000 is a liability, we're not reporting it up here in cash, so it really belongs in our answer to Part B. Because if you remember, Part B said that if there's an item that doesn't belong in cash, tell us where it goes. So in this case, the $35,000 is going to be a current liability because there's no available cash at the Royal Scotia Bank to offset it. Now, let's go back to the second point in the question. Fashion agreed to maintain a cash balance of $100,000 at all times in its checking account at First National Bank. Now, this part here, when it says they've agreed to maintain a balance, that's what we would call a compensating balance. Many times companies want you to, or banks might want you to have a compensating balance so that, say for example, there's a loan outstanding with that bank, they want to make sure they could dip into that little reserve that you're keeping as a compensating balance at their request. So if you don't pay all or part of your loan, they can attach to that. So in our case, that's already in cash. So we wouldn't need to do anything to separate it out. You don't need to add it to the cash balance, deduct it to the cash balance, nothing like that. So what we would say here is that the compensating balance at the First National Bank of $100,000 is a requirement that does not affect the cash balance. It's already in these balances here. So if you go back to the question, it says they need to maintain that $100,000 balance in their checking account. So their checking account is the one that has the $900,000. That $900,000 already has, as a subset of it, the $100,000 compensating balance. So it doesn't affect the cash balance any more than it already has because $100,000 is part of that $900,000. All we need to do is make a note disclosure. So when we present our cash in the current assets section of the balance sheet, we might want to have a note next to it. And in that note, when we go into the financial statements, we would see that note disclosure would say that $100,000 is being held as a compensating balance. And we would do that so that any users of the statements to whom we might owe money would already know that that $100,000 is earmarked for a debt at the bank. Now, let's look at the next item. The next item, number 3, Fashion has a $5 million investment at the Commercial Bank of Montreal in a money market mutual fund, but it has checking account privileges. So as soon as you know you have a money market fund that has checking account privileges, that means you can write checks against it. So by definition, You remember what we talked about earlier in this segment? $5 million investment is going to be considered cash. So what we're going to do is we're going to include it in our cash balance calculation and add that $5 million in there. Okay? Now, let's go back to the next item. We have travel advances of $18,000 for executive travel for the first quarter of next year. So we've processed this amount of money, $18,000, and we've advanced it to our employees so they could make their travel plans. Okay, so now employees, we're going to complete their expense report after they travel. So what's going to happen? If we've given the employees this money now, that's like prepaid travel because they're out there now making their travel arrangements. So basically what we're doing is we're saying, well, we're going to front you the money, and when you do your expense report, whatever we may owe you over and above the $18,000 that we've given you, we'll add that to what we owe you, right? But if you have put on your expense report, maybe your expense report is for $15,000 and we've advanced $18,000, then you're going to owe us money. But the idea is that this amount has been given to the employees in advance by the company, so that's considered prepaid travel. So in our case, what we would do is we wouldn't put it as part of cash because it's a travel advance. So it would go in our asset account prepaid travel for $18,000. Now, if we look at item number 5, we've got a separate cash fund in the amount of $1.5 million, and it's restricted for the retirement of long-term debt. So as soon as we have some cash restricted for a long-term purpose, we know it's going to be a non-current asset. So it's not going to go with the rest of the cash in the current assets section. It's going to be considered a non-current asset, and it's going to go in as a long-term investment. So what we would say here is that restricted cash of $1.5 million is a non-current asset, and we would classify it as a long-term investment in the long-term investment section of the non-current assets. And we would call it restricted cash for the retirement of long-term debt. Now, if you decided that you just wanted to stay restricted cash and then have a note next to it, and then in the notes section, you would say that the restricted cash is set up to retire long-term debt. You could do that. But this is quite fine too, just to say it's restricted cash and then have this parenthetical disclosure that it's for the retirement of long-term debt. That's absolutely fine to do. But notice it's not here in your current cash asset balance. All right. Now, let's look at item number 6. Item number 6 says there's a petty cash fund of $3,000. Well, you know from your previous studies in accounting, that is considered cash. So we would have that amount of $3,000 up here to help us calculate the cash balance. Let's look at item number 7. Item number 7 says we have an IOU from Marianne Cook. She's a company officer, and that amount of money is going to be withheld from her salary in January 2018. Don't forget, we're at the end of 2017 right now. So the company has advanced an employee some money. IOU stands for IOU money. So the idea here is that $1,900 is owed back to the company. So we would consider that a receivable from our employees because we've advanced the employee money that they have to pay back. So therefore, in this case, we wouldn't have it in cash, but we would have it in employee receivables or receivables from company officers. But the idea is it's not part of cash. And in fact, it would be in the current assets section of your receivables or for the receivable, right? Now, let's look at item number 8. Item number 8 says there are 20 cash floats for retail operation cash registers. 8 locations each carry $475 float, and 12 locations carry $600 float. So that's still cash. So it's part of our cash that we would include in our cash balance. So if we take 8 times 475 and add that to 12 times 600, in total, we see this would add up to $11,000. So we need to make sure that when we're creating our cash balance amounts, that we include that cash float in the amount that we're going to record as cash in the current asset section of the balance sheet. Now, if we go down to item number 9, we're going to see that the company has 2 certificates of deposit, each for $500,000. Each of these certificates has a maturity of 120 days. Now, this should be a red flag to you right here. If the maturity is 120 days, we know for certain it can't be a cash equivalent, because cash equivalents have a maturity of 3 months or less. Well, 3 months would be around 90 days on average. So we know it's not going to be a cash equivalent. So what's it going to be? It's not going to be cash either, because we can't attach to it any time we want. It's got a maturity of 120 days, and after that 120 days is up, then we can attach to it. So how would we handle this item? Well, it's really a short-term investment. Why is that? Well, if we think back, it's a short-term investment because it's an investment that, even though it's for a fixed term and it's got a fixed rate of return, we can't cash it within a 3-month period. So we would consider it to be a longer term than 3 months, but not a long-term investment because it's within a year. So we would classify it as a short-term investment. Now, what about the next item? Fashion received a check dated January 12th, 2018. It's a $25,000 check, and it's from a customer that owes you money, so it's an account receivable, and they owe you money at December 31st. So, when you receive that check, you're still in December, right? Because they said that they're trying to determine the amount of cash they're going to report at December 31st. So you'd have to assume here that this money came to you, or this check came to you on or by December 31st. Well, the fact of the matter is the check is post-dated. So technically you can't cash it and apply it to the customer's receivable account until that January 12th date happens. So we would include that in accounts receivable. We wouldn't do anything with it yet. So this first post-dated check of $25,000 is not going into cash. It's going to remain in accounts receivable. What about the second check? We have a second check here, and this check is dated January the 8th. So again, another post-dated check, and it's an amount for $11,500 from a customer who gave us an advance on an order. So the idea here is that we probably ask the customer to pay us in advance before they place the order. So we're not going to place the order unless we have a firmer commitment from the customer, and we get that firmer commitment when we ask for some money up front. Well, that money up front to us is really more like an unearned revenue, right? But again, it's a post-dated check. We can't cash it. So the idea here is that we have a post-dated check that we cannot yet cash. So what are we going to do with it? We keep it in a box or keep it locked up in our desk or in our company vault so that when January the 8th comes around, then we can cash it. So it's not cash. All right, so if we look here, how could we classify it? Well, it really is for unearned revenue, but we can't make a journal entry yet. Why? Because we can't cash the check. So normally, if we were getting a check now as an advance payment, we would debit cash and credit unearned revenue, but that assumes you can cash it right away, but we can't. So we wouldn't do anything with it. We would leave that check in a box locked up in our desk or in a vault until the January 8th date comes around, and then we would cash it. And we'd debit cash and we'd credit unearned revenue at that time, at January the 8th. Now, let's look at the next item. It says Fashion holds a $2.1 million commercial paper. Commercial paper is, maybe like some kind of an income or security of Rocco Leone, and it's due in 60 days. Well, again, if it's due in 60 days, that means what? It's due within 3 months. So to us, that's like a cash equivalent. So, because it's like a cash equivalent, we would say it's not in cash. We set it up as a cash equivalent. I just wanted to change that line so that it would read a little more directly as a cash equivalent for you. So that's why I paused the video. Because in this question, what we see is that it's due in 60 days. So that would make it a cash equivalent. All right. So now, if we go back to our next item, or first of all, I guess we should show you it's a cash equivalent, and it's not going to show up here, right? Because it's a cash equivalent. Cash equivalents are not cash. Sometimes they're lumped together in the statement of financial position, but they are separate. So now, if we look at item number 12, we have currency and coin on hand. Maybe we have that in our vault or wherever, and it's 7,700. Well, definitely that's cash, right? So we would put that in calculating our cash balance. Okay, 7,700. Now we're going to look at our final item here. And in our final item, we have 1,000 shares of Sortel. We bought it at $3.90 a share in late November, and we held them for trading. So they're fair value through net income investments, right? Anything that you're holding for trading means that you're going to trade them regularly, so they're fair value through net income, not cash. But at the end of the year, December 31st, 2017, they have a value of $4.10 a share. So in that case, if they have a value of $4.10 a share, we would value them at fair value as a fair value through net income investment, still in the current assets section, but certainly not cash. So in our solution, what we have is we've got here, down at the bottom, the investments, because they're trading securities, are fair value through net income, and we would show them at a fair value of 4,100. So we've looked at everything that needs to go into cash, which is right here, and everything that doesn't go into cash, we found a home for. So if we add up all these numbers that we have here, we'll see that the amount of cash that we should be reporting on the statement of financial position in the current assets section is $6,521,700. So this concludes our problem on figuring out what goes into cash, and if it doesn't, where we would put it on the statement of financial position. I hope you found the video helpful.